Apple just reported numbers beating analyst estimates, and the stock jumped a few percentage points on the news. But is Apple stock a buy from a fundamental intrinsic value perspective? In this video, we will compute a discounted cash flow calculation to answer that question. Let's dive into it. Apple, as you know, drives its business from the sales of iPhones, Macs, iPads, and a variety of accessories, as well as services such as Apple Music, Apple TV, Arcade, etc. And it also gets a 30% cut from the sales in the Apple stores on mobile devices. As for the last revenue numbers, the biggest revenue stream is the sales of iPhones, followed by services, wearables, Mac sales, and iPads. These revenue streams allowed Apple to become the largest company in the world by market cap, getting now close to the 3 trillion mark. So let's look into Apple's latest numbers. Revenue grew steadily in the past 10 years at an average 10% compounded growth rate, and so did net income, 10% per year, cash flow from operation at 9% per year, and free cash flow at 10% per year. This compounded growth in top line, bottom line, and free cash flow followed each other perfectly at the 10% mark and shows how stable Apple business is and that Apple is in a stage of life where it can truly generate a lot of stable and compounding profits. Gross margins, which represent the amount of revenues left for Apple after you remove the cost of producing the goods, stood fairly stable in the high 30 to low 40% range. Operating margins, which is the gross margin after you remove operating expenses like salaries of Apple employees, stood in the high 20 to low 30% range. And free cash flow margin, which is the percentage of revenue that materialized into cash for the company, ranged from a low of 23% in 2019 to a high of 30% in 2015. Capital expenditure or CapEx fluctuated in the 10 years, from a 8 billion to a 13 billion figure per year. Importantly though, there has not been a steady increase over the years, and this means that as revenue grows, more and more profits are available for the shareholders. The number of shares have been declining over the years at a compounded rate of 5%. This is thanks to share buybacks and is a major way in which Apple rewards its shareholders. Dividends also increase over the years, being the second way Apple rewards its shareholders. So once again, a very stable and a solid company from an operational perspective, just as you would expect from Apple. To make the calculation of how much Apple fair value is, we need to estimate the future cash flows. So I pull out the revenue estimates for 2022 and 2023 by analysts, and you see them here in red. Analysts are therefore estimating a growth of 4.7% and 5.2% over the next 2 years, which if you average is 4.9%. I think that 4.9% is a fair long-term estimate of revenue growth for such a mature company like Apple. So I prolong the 4.9% growth estimates for the 8 subsequent years, and that delivers the projected revenue numbers that you see in this row. Next, to estimate future cash flows, we need to first estimate the free cash flow margins. In the trailing 12 months, I calculated the free cash flow margin to be 27%, which is close to the 10 years average of 26%. I'm actually bullish on the margin going forward. We have heard from the top management that they are hinting at focusing on profitability going forward, as well as we have seen CapEx growing at a slower pace than revenue growth and operating cash flow over the past years. I think that the free cash flow margin will therefore marginally increase over the next decade. I chose to keep the 27% figure for the next 2 years, and thereafter increasing it gradually toward the 30% mark in 2031. 30% is not a crazy value. As we have seen it earlier, it reached 30% in 2015, so I think that I'm being realistic here. Alright, now that we have revenues and margins estimates, we simply multiply the two to calculate the future free cash flows. This gives a predicted free cash flow of 103 billion in 2022 and 177 billion in 2031, or a compounded annualized growth rate of 6.3% in the periods. Moving to the discounted cash flow calculation, we have the input parameters, which is the growth rate that we discussed, I fixed to 6.3%, the discount rate, which is 11.8%, That is the weighted average cost of capital. And if you're interested in how I calculate it, you can pause the video and check out this calculation over here. Okay, so here in green there are the latest trailing 12-month cash flow values reported. And over here there is the estimate of future free cash flows that I pulled from the previous table up to 2031. In the row below there are the discounted values. Over here we have the terminal value of the business after 2031. I computed two calculations, the exit multiple and the perpetual growth model. For the exit multiple, I looked at the price to free cash flow valuation of Apple from 2006 to today, and as we can see, the valuation went bananas in the last few years, reaching almost 30. In the long term, I don't think this is sustainable, so I will take the average, which is 14.62 for the period. So I put 14.62 in the terminal multiple input cell here. In parallel, I calculated the terminal value with the perpetual growth model, setting 2% as the perpetual growth rate. And we have the results here. In this cell, I summed the future discounted cash flow values together with the average from the two terminal values. I then corrected for cash and total liabilities and divided by the share outstanding. I get a fair present value of Apple to be $77.84 per share, which is dramatically lower than the current price it is trading at, which is 165 as I'm writing this video, suggesting that Apple is strongly overvalued at the moment. In conclusion, Apple is a stable, established company with a big moat and brand. Although it did not release any revolutionary product in 2021, it still reached record sales and profits, showing how it can continue making small incremental improvements in its products and still hit the numbers. iPhone continue being the biggest revenue stream for Apple, which I expect to keep on having strong, stable numbers in the long period. When a consumer is acquainted to the iOS ecosystem, it is likely to stay in the ecosystem, and this drives consumer stickiness to Apple products. Services, wearable, and accessories is where Apple has a chance to capture growth going forward by expanding its product portfolio. There are several rumors from Apple Car to Apple Glasses for augmented reality, but nobody can estimate when this will become a reality. So I like to think of them as an optionality on the upside. Another positive is that Apple is committed to return all the extra cash on its balance sheet to shareholders through dividends and buybacks, signaling a maturing of Apple business. Moreover, Apple business is shifting, drawing more and more revenues from subscriptions like iCloud, Arcade, Apple TV, Apple Pay, etc., therefore creating stable revenue streams of income. On the other side, a big risk for Apple is regulatory risk. The 30% cut they take from the App Store, discounted to 15% to small businesses, is at the center of controversy for regulators because essentially there is no other way around if you're a developer, and this gives Apple monopoly power. Another risk is supply chain disruption, and we have seen in the last 2 years of lockdowns how fragile the global supply chain is. Apple does not manufacture its own chips and therefore is particularly sensitive to the supply chain shocks. Based on my valuation, Apple is quite a lot overvalued now, and it should fall to approximately $78 per share before it becomes an attractive investment for me. Full disclosure, I don't own any Apple share. I hope you found this video interesting. Don't forget to leave it a like and let me know in the comments below if you own Apple or if it is in your watch list. See you in the next video. Before we go, I must remind you that I'm not a financial advisor and this content is not financial advice. It's just my opinion and you should do your own due diligence before investing in any product. Have a great day.